Bond yields and earning yields are among the two most important decision-making tools for money managers. And investors are again facing the challenge of capital allocation as the yields on 10-year bonds have reached 6.3% after a steep decline in the last 2 months. Let's do a 3-point analysis to find out whether one should stick to equity markets or switch to bond markets. 1. What are bond yields and earning yields? Well, active market participants keep on shifting the capital across equity and bond instruments depending on their attractiveness on a relative basis. While bond yield is a measure of the current yield that is calculated by dividing the interest income by the market price of the bond, earnings yield is the inverse of price to earnings ratio and is calculated by dividing the earnings per share by the market price of the stock. 2. Is there a correlation between the two yields? Well, the spreads between bond and equity market yields tend to work in phases. Historical data suggests that when the yield differential reduces, the equity market either consolidates or corrects. On the contrary, the market gives strong and sharp up moves when the yield differential increases. Between July 2010 and 2013, the differential continued to decline and equity markets were in a long phase of consolidation. The spreads in July 2013 started the expansionary phase. The gap widened to around 4% and the equity markets went berserk with Nifty surging 50% up to January 2015. The next phase was again a contraction phase till December 2016, post which the spreads yet again bottomed at the time of demonetization, and Nifty resumed its uptrend and jumped by 40% over the next 18 months. 3. So where is the Nifty headed right now? Well, the 10-year bond yields peaked at around 8% in July to August last year and have been on a downward spiral ever since. Successive rate cuts by the RBI along with the slowdown in the domestic economy are the primary reasons for this decline. Now, this yield spread gap between the equity and bond markets has been narrowing since July 2018, which suggests that the current phase is again a contractionary phase. The analysis also indicates that the cycle is just 12 months old and markets should either consolidate or correct until the gap narrows to the historical bottom of 1.8% from the current 2.8%. Now, despite low yields, investors should park their money in secured bonds for a long time, being as well as they can also look at switching to equity markets only during corrections.